What do you make of this week? How should we view it? Obviously, these concerns about inflation, this rotation that we've seen, dramatic as it's been out of some of the big, very highly valued growth names into value. Will it continue?
Yeah, David, good question. This week's data is just a stark reminder that this recovery is going to be like nothing we've ever seen in our careers, similar to the way the recession last year was like nothing we've ever seen. I mean, you're talking about a month-over-month CPI number earlier this week that was the highest in nearly 40 years, which is really an eye-opener. And I think what Rick went through on some of those, longer-term inflation expectation numbers are certainly going to catch the Fed's eye. However, there is nothing that we've seen this month or this week that is getting us to change our view that investors should be overweight U.S. equities and adding balance to a growth posture that worked for years. That is not going to work. We expect this to continue through the end of the year, David, and I think that some of the things that folks should be open to is getting away from the cap-weighted index exposure, which is just the largest and most popular companies, into more equal-weighted index exposure, where you want all 500 companies at the S&P. And I think value still makes a lot of sense, as you can make the argument right now that the U.S. consumer has never been as strong and rearing and ready to go as they are right now, which should help value in the U.S. as well as abroad in places like Europe.
I mean, Phil, we can go back so many years where there was hope for those value investors, and then it was just dashed as they watched growth severely outperform. What, in your mind, is going to make it different this time?
So what's going to make it different this time is the fundamental backdrop that we haven't seen anything like this since Ronald Reagan was president. And David, you can replace the value head fake with Europe as well. It's kind of the same thing. I mean, the people that have talked about Europe, it was like a blasphemous word to add to a balanced portfolio. But what makes Europe a little bit different, similar to what we've been talking about in the U.S., is the fact that we're going to pass the baton of the peak of the global recovery to Europe in a couple of months. So that's new. We really haven't been able to say that a lot. We're also looking at German Bund rates almost getting back to positive. I mean, I'm going to throw a party when German Bund rates go positive. So that's definitely new information as those rates are moving higher and helping financials. And then the European Recovery Fund, which obviously is a symbolic kind of matching a fiscal union with the monetary union, is something that we haven't seen before. So, that fundamental backdrop, the savings rate in the U.S., not enough people are talking about the U.S. savings rate at 15%. Just to put that into numbers, that's $6 trillion in a savings rate, right? And that was about $900 billion pre-COVID. So these are all really important data points that are new to 2021. And it's very crowded to have stocks in your portfolio over bonds. Everyone's saying that. We've seen tremendous flows into equities. The difference this year is going to be security selection, David, and that's where the kind of value balance comes in.
Shepard Smith here. Thanks for watching CNBC on YouTube.